Welcome to our quarterly market update for the end of September 2023. Now, to be honest, up until about 2 weeks ago, I didn't think I'd have anything to say because it's actually been a very benign period in stock markets. Volatility is low and markets kept going up and up and up. But it all sort of changed a few weeks back. So while markets had been ignoring the fact that interest rates have been going up, they also believe that it's going to be a nice soft landing that we're going to come into and then rates will start coming down. The central banks told the markets that rates are not going to come down anytime soon. Now, coupled with this, inflation remains sticky and particularly oil is up 30% for the quarter, which is keeping inflation high. Then on top of that, China's economy is not really kicking on, and that's making economists reassess global growth going into next year. So what we're going to see is that markets around the world have been flat or slightly negative for the quarter. But it hasn't been a bad 12-month period. Let's start by looking at the Australian stock market here. And you can see that over the 12 months, the market's up. But again, it's come off just in those last few weeks. If we turn now to the developed markets, it's an even stronger return over the full 12 months. It's up by more than 20%. But again, you see it's negative or slightly negative in this quarter. Now, the largest contributor to developed markets, if you like, is the US. And the big driver of the US, and you'd have to say the rest of the world, has been the big high-tech stocks in the US. We've all heard about the Magnificent Seven and the AI craze. They've certainly had quite a run up until 2 weeks ago. So it won't surprise anyone that the biggest fall in markets in the last couple of weeks has been in the IT sector. And in fact, the US IT sector is in correction territory. In other words, it's down by more than 10% since its highs back in July. Onto the emerging markets, and similar story, again, very flat return for the quarter, and an okay return for the full 12 months. But the biggest contributor in the emerging market index is China. So after the lockdowns were eased, everyone was expecting that China would take off. And that just hasn't happened. You'd have to say it's been a really bad year for forecasters because at the start of the year, everyone was saying that we're going to head into a recession. China's going to kick goals though, and then interest rates are going to start coming down. Well, none of that's happened at all, and analysts now are sort of reassessing where they thought the market would end up, trying to move it more into line with what the market has done. I can't leave you without talking about bonds. I mentioned earlier that over the course of the year, the stock market had been going up and up and up. Unfortunately, so had bond yields, and when bond yields go up, bond prices go down. And you can see in the chart here we're showing the US 10-year Treasury yield, and against that we're showing the quarterly returns of the global bond aggregate index. That's the big global index. It's hedged back to Aussie dollars. But you can see while there was a bit of a kicker there in the March quarter, that's when the couple of US banks fell over. Well, that seemed to pass as a bit of a whimper, and yields kept climbing, and they've been climbing even more in the last few weeks. And the bond market would be suggesting that inflation is not going away anytime soon. Let's just summarize the quarter. Equity markets have had a very strong 12 months return, principally driven by the big tech stocks in the US. However, stocks have come off their highs in the last few weeks, and for the quarter, most major markets are either a little bit negative or flat for the quarter. Bond yields continue to move higher as inflation persists, and central banks have reiterated that they see rates staying higher for longer. That's it for our quarterly report for this quarter. Thanks for watching.